Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing medical properties trust stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, $3 billion market cap. They're trading at $5 a share and they have 600 million shares outstanding. This company buys property to allow hospitals to run their businesses. It is a REIT that invests in healthcare facilities with triple net leases. Triple net includes taxes, insurance, and maintenance. It owns 400 properties in the US, Australia, Colombia, Germany, Italy, Portugal, Spain, Switzerland, Finland, and the UK. Founded in 2003, based in Alabama. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow has been going down a lot each year, from 800 million to 700 million to 500 million. Now it's only 300 million. Their biggest tenant has been struggling, so that's why their revenue and cash flow has been going down. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's pretty flat each year, around negative 400 million. They have lots of write-downs, lots of depreciation. That's why they have negative net income. Revenue is a sales for the company, and that's gone down a lot as well, from 1.5 billion to 640 million. But since the stock has been going down a lot, their dividend yield has stayed strong. They pay a 6.5% yield, which they can cover. They can cover that 1.6 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated the terminal value, it's all cash flows past year 4, that's 4.8 billion. We discounted those numbers back to today's weighted average cost of capital. We got a value of the company of $4.2 billion. We divide that by 600 million shares. And we get a calculated stock price of $7. They're trading at $5, so they're trading at a 30% discount. It's a buy according to the model. There are 17 companies in the same industry as MPT, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They have negative CapEx, which means they're selling off a lot of properties. When a company has positive CapEx, that means they're spending a lot on property, plant, and equipment. So it appears they're selling off their business. Their debt to equity ratio is 1.7. The average is 3.7 because Strawberry Fields is 46, which drags up the average. They pay a high dividend, 6.5%, not the highest on this list. REITs tend to pay really high dividends. They generate 300 million of free cash flow, which is higher than median average. They rank 9th in market cap, close to 3 billion, similar to National Health Investors. Welltower is number 1 at 86 billion. They have a really good price to book, 0.5, which means their market cap, the P, is half their equity, the B. We can't look at their PE, negative earnings. A really good price to free cash flow, 9.8. A good price to sales, 4.6. Diversified healthcare is the best at 0.4. Their revenue is equal to the median. Their 5-year annual revenue growth rate is the worst, negative 4%. Most companies are positive. And it looks like they're trading between their 52-week low and 52-week high. A little closer to their 52-week high. They got down to $3.26 at one point, and they're almost at $5 currently. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd have $6,800 today. That's a 31% loss. But at one point, your $10,000 would have been about $22,000. The stock plunged when Steward Healthcare filed bankruptcy. That's their biggest tenant. To summarize, I have them trading at a 30% discount. I give them a ranking of 6 out of 10. I'm not sure I would buy it short term. It seems a little risky, but for a long-term play, I think it should do really well because they're getting close to their bottom. I think they hit their bottom when they fell to 3.25. So I don't think there's that much downside left, unless they go bankrupt, which I don't think they will. Ratios look real good, 7 out of 10. Financials look awful, 1 out of 10. They keep going down year after year, but that should be plateauing and it should start going up soon. Let's take a look at their income statement. This is the third quarter of 23, third quarter of 24. Their revenue keeps going down. It was 306 million, now it's 226 million. They break it down to 4 categories. Rent billed, that was 170 million. That's the rent they receive from their tenants. Straight line rent, 37 million. They also finance some of their real estate. So income from financing leases, 10 million. Interest, 10 million. What is rent billed? Let's see if they explain that. This sheet shows percentages. So rent bill is 75%, straight line 16%, and the other two are 4% each. I don't see an explanation for rent billed, but we could just assume it's the rent they charge at tenants. I wanted to see how they define it relative to straight line rent. Let's see what they say about straight line rent. Straight line rent is an accounting method used in commercial real estate to average the total rent due over the term of the lease. So that's just summing up each month's rent, then dividing by the number of months. Because if you have a tenant move in and you give them 6 months of free rent, and then they pay monthly rent for the next 10 years, you would spread out the rent payments over 10.5 years. Even though the tenant does not pay any rent, you will show rent on your income statement. So the rent on the income statement is accounting, it's not actual cash. Let's see what they say about income from financing leases. That was down $16 million due to not receiving any cash for rent from Prospect. Last year, they recorded $16.5 million of rent from this customer. But they did receive $200,000 more from the increase in CPI, Consumer Price Index, above the rent from last year. Let's see what they say about interest and other income. It's down approximately $20 million. Interest from loans is down $19 million due to a $17 million increase from Steward. Steward went bankrupt, so they lost a lot of rent from that customer. That was their biggest tenant. They did receive $1.6 million more of interest income from the prime mortgage loan in the second quarter of 2024 as the result of the prime disposal. They talk more about that in note 3. They added $106 million of net assets, $108 million in joint ventures. A joint venture is when they buy something with another company. This really doesn't clarify things for me, does it for you? I think if we scroll down more, it'll talk about prime. Right here, disposals, 2024 activity. In April 2024, we sold 5 properties to Prime Healthcare Services. They just call that Prime, for total proceeds of $250 million, along with a $100 million interest-bearing mortgage loan. This transaction resulted in a gain on real estate of $53 million, partially offset by a non-cash straight-line rent write-off. I think we're getting too far down the rabbit hole. Let's go back to the income statement. Below revenue are their expenses. Interest, that's the interest they pay in their debt, $106 million. They have lost depreciation, $204 million. That's a non-cash item. G&A, $36 million. They have payroll and things like that. So total expenses, $350 million. They pass through lots of impairments, probably from Steward, $607 million. It was $1.4 billion in the trailing 9 months. So they had a pre-tax loss of $790 million, net loss of $800 million. Last year, they had a net gain of $117 million. And they're adding shares. Last year, $598 million, now $600 million. Let's look at their balance sheet. Total assets, $15 billion. Most of their assets is the real estate, the land, the buildings, the improvements, $11.7 billion. Then they have financing leases, $1.2 billion. When they finance some of the real estate, that's an asset for this company. The person receiving the real estate, the person receiving the loan, that's debt to them. So it's a liability on their balance sheet. They have $1.2 billion of investments in joint ventures, and they have $10 billion of liabilities. Most of that is debt, $9.2 billion. They do give a breakdown of the debt. They have $400 million in the credit facility. They footnote that A, that includes 300 million pounds of debt, 300 million euros of debt. They also have term loans. The biggest is 1.4 billion due in 2027, 5% interest. Some of the notes are under 1%. I know they just mentioned some debt financing. I guess they're always adding debt, so that's probably nothing new. Assets minus liabilities equals equity, 5.4 billion of equity. They raised $8.6 billion from selling their business. They lost $3.2 billion from running their business. Let's look at the statement of cash flows. Even though they had a net loss of $2 billion, this is for the trailing 9 months, they did have positive operating cash flow, positive $169 million, which is half of last year. Last year was $370 million. The reason they have positive cash flow is because most of that loss was an impairment of $1.4 billion. That's a non-cash item they add back here. They had a cash inflow of $1.2 billion from investing activities. A lot of that is from the sale of real estate. They received $1.8 billion. In their financing section, they had a cash outflow of $1.4 billion. Most of that was to pay back a revolving facility, $1.1 billion. They paid $270 million of dividends, half of last year. Let's take a look at Simply Wall Street. Its last price, $4.95, 2.9 billion market cap, up 4% in the past week, up 39% in the past year. So it looks like it reached the bottom. It's only uphill from here. It started trading back in 2005 at about $10, $11 a share. By 2009, it fell to $3. If you had the foresight to pick it up, you could have went from 3 up to 24 right before COVID. You would have received a lot of dividend payments, well more than your cost basis. Then the COVID dipped down to about 13, then it ran up to 23. That was in January 2022. And it's been going down a lot since then, mainly because of Stewart. They didn't file bankruptcy until around right here, about a year ago, but they were having trouble. The writing was on the wall. So that's why the stock kept coming down. I think it's a good time to pick it up. I mean, I thought that a year ago when it fell to $3, but you can see it's been trading sideways for the past year. It went from 3 up to 6, back down to a little over 3, maybe closer to 4. But if you get it at $4 and the stock gets back up to 20, your yield would be like 50%, because the dividend yield should be calculated on your cost basis, not what the stock is trading at. Simply Wall Street thinks the stock is overvalued. They're at $4.45. 8 analysts priced this stock at $4.56. They also say it's overvalued. I guess nobody agrees with me. Here's their revenue since 2014. It was $260 million, and it grew for nearly 10 years up to $1.6 billion. That was the peak. It's down like 70-80% since then. $660 million. Okay, maybe down like 60%. They do have a lot of debt. $1.5 billion in 2014. It got up to $11 billion in 2021. Now it's at $9.2 billion. But their equity is usually pretty close to their debt. Now their debt is a little higher, since their debt is $9 billion, equity $5.4 billion. And they don't have much cash on their balance sheet, only $275 million. That's still a lot more cash than I have on my balance sheet. The CEO's salary is a cool $1 million. Total compensation, $18 million, tenure as CEO, 22 years. So he's been with the company since the beginning. In the past year, mostly insider selling, one buy. 64% of the company is owned by institutions, 21% by the general public, and 15% by insiders. The biggest shareholder is BlackRock at 15%, then Vanguard at 14%. There's Schwab at 1.5%, Silver Point 1%, Northern Trust 2/3 of 1%, and Co2 Management 0.4%. Their employee count is pretty low. REITs don't have many employees. It was 39 in 2014. Now it's 121. The ticker trades on the New York Stock Exchange, Deutsche Börse, London Stock Exchange, Mexican Bolsa, Bulgaria, and Sao Paulo Bolsa. So if you want a copy of my discounted cash flow model, click on the video in the top right corner.